Hi all and welcome to Erik Penser Bank. My name is Jonas Thulin, I'm head of asset management, and I always try to make this very brief as a tip of an iceberg to analysis, but this time I sincerely try to keep this very brief. But it's also a bit of a challenge given the fact that we have so many conflicting signals and different paradigms and different layers of the market that are happening at the same time. For us, this means that we cannot talk about one view of the market anymore. As you can see, last week we had earnings that beat the market, but we didn't get paid. Now we still beat the market, we get paid, but you have some sectors that are getting atrociously badly paid and also cannot beat the market. For us, this means a little bit of a challenging from a communicative point of view that we have to respect the global equities were down in April. Global bonds were down in April. We were also down, but a lot less so. That means for us, it made perfect sense to be maximum weight to equities, even though we had a very bad equity month of April, because our global equity basket performed better than global bonds. Therefore, we can keep it without, so to speak, having an alternative that would have protected us more or performed better. Now, this is a combination of very nitty-gritty positions that we have on. It's a combination of various currency flows, etc., etc. But the point that we're making here is that we do not believe that we're in a rising tide environment anymore, i.e. once the US market is getting lifted by whatever aspect, the rest of the world will follow. We have a clear regionalization, we have a clear building of economic blocks out there. We think we should take that seriously, both from a supply and demand perspective, but also from an asset allocation perspective, i.e. the strategic work is a lot more important now than it has been for a number of years. The tactical work is even more important. And you can come up with these weird conclusions that, yes, we do realize we're in a very tough equity month, given April, but we're going to stick to maximum overweight because we're getting better paid there than we would have been in global bonds. So April was a weird month. It was one of our better months from a relative perspective, but it was obviously a down month. So we still have a lot of work to do. But the main conclusion here is that we, like P.G. Wodehouse wrote a couple of decades ago, I mean the tidal wave that disappeared. It walked out and didn't come back. I think we were in a different kind of environment. We're in the same kind of environment right now. And another aspect I want to bring to your attention is, should we sell in May and walk away? And we say, yes, absolutely, you should sell in May and walk away if you keep that strategy for 11 years running and you time a euro crisis during May, June, July. If you do not plan to keep the strategy for 11 years and you do not believe you're going to have a euro crisis, debt crisis, or you just invest in the US, you should not care about selling May and walk away. For that matter, for us, it's a completely pointless kind of old saying. If you look at since 2018 for Sweden, Euroland and US, you would have made less money if you stopped out and simply didn't take part of the equity market. You have to backtrack this 11 years until you actually make money on it. And obviously that coincides with the euro crisis. So it all depends on that crisis that happened during the summer. So for us, that is not a viable reason. So we think this makes a little sense, as rising yields should mean you should buy bank equities. Yes, there was a case there. The statistics died away some 20, 30 years ago. It's the same about this thing. I mean, it simply doesn't hold up to statistics anymore to sell in May and walk away. What it does is accentuate perhaps what we just spoke about, the importance of trying to keep the right global equity portfolio, or not the right, there's always never a right, but as good as possible in order to avoid pockets of risk. For us, we are, as you know, we are almost completely out of the Eurozone. We have one strategy there, 5% of our portfolio. It is healthcare in Europe, and that's a stagflation trade, stagflation hedge, if you like. So that's the only position we have in Eurozone for the time being. We have Fed coming up in the week. Obviously, we still listen to the break-even market in the US that continues to claim that this is the most transitory inflation spike ever. Transitory. I don't know the phrasing of that. I think the Fed has corrected it, saying there will not be a permanent mark on inflation, i.e. 5-year mark. That's probably a bit more calmly put and a bit more vaguely put. If you look at the break-even curve versus headline CPI, there's a clear downside. Will this materialize? Well, we hope not, because then we're going to have deflation debate within a year. But nevertheless, we still believe that we are past the spike, as we communicated before. We saw that in March, and we keep trades on for that, most notably a bull steepening in the US. And if this is true or not, we'll wait and see. This doesn't take away the fact that the Fed will hike. We have a lower end of the year target than the market, because we do not believe the Fed will hike, then cut, then hike, then cut. We think they're gonna, if anything, make a shortcut and make a straight line through this kind of Fed fund futures environment. And that comes back to the credit risk, the CPI peak. If we're wrong on the CPI peak, we're going to be wrong on this assumption as well, in this forecast. We're going to be a bit wrong on keeping so much growth in our portfolios. But for the time being, when we get data that supports our call for peak inflation, and that you have in for example, break-evens or your credit card spending on gas stations, we're going to stick to it. One more aspect that we want to bring to your attention is this discussion between flow and stock in terms of balance sheets of central banks. Now you can pretty much see that there's a lot of attention in media, obviously, that the Fed will cut back the balance sheet. You have the balance sheet up here, $9 trillion. But it's actually the flow in relationship to the market or the economy that actually matters from a market pricing point of view. That has been the case since Q2. It was not the case in Q1, then the flow was complete, reigning the agenda. But since Q2, twist, Q3 and Q4, etc., and the fiscal stimulus, it's been the flow that has mattered. If that is right, then we can certainly start to think about CPI from a different point of view, and I will show you that in 1 second. But also note that peak stimulus was at the end of 2020. And since then, we're in an environment of decreasing support from this. Hence, from a flow perspective, given the size of the economy and how the economy is growing, it is not a challenge for the economy, as nominal GDP growth is growing about 10% for the time being in the US. Euroland, it's a bit of a challenge. That's why Euroland will be slower in this. The euro will fall versus the dollar, as it has. But we're sticking to the flow. And if we're right on this, it will be quite interesting to look at the CPI. This is the headline CPI in the US versus the core, versus the flow of central banks or fiscal or liquidity as a proportion of GDP growth. And you can see the peak that we saw back in 2020 that we've been pushing forward to the peak in CPI, and the potential CPI trajectory that we're going to head into as the supply bottleneck is breaking down as we're speaking. Now, we're fully aware of what's happening in China. It has not transmitted to the US as such. We think that's going to be handled by the Chinese, who are obviously aware of that factor. As long as that sort of holds, we're going to stick to the flow camp. We're going to keep growth, and we're not going to join the stock camp, even though we know, and everybody knows, that's going to be the 90% of the media communication. It's actually the flow in relationship to the economy that matters. So that's our point of view on the runoff that will be communicated this week, up to about $95 billion per month from the Fed. And I mentioned growth just previously on this flow, and what has happened last week, which we think was really interesting, is our reflation trade indicator, which is trying to pinpoint if we should be in growth or value, and it's been struggling against the market by keeping us in growth. And obviously right now we're getting a bit more paid by growth is sort of catching up to value. But this decisive step in this indicator shows a decisive step in the market, both from the fixed income and the commodity market, on how the pricing future prices, i.e. a downside. That means shorts starts to outweigh longs, etc., etc., etc. We also put in a currency overlay over this in terms of positioning. But we think this is really interesting to keep on track on, because that coincides with peak supply chains, it coincides with peak inflation, it coincides with the break-even curves, it coincides with the central bank from a flow perspective. So in that point of view, it makes almost too perfect sense to keep growth in that perspective. But it would be really interesting to see if that materializes, or if the rational or the econometrics will break down at one point where we would simply have to change our positions. For the time being, we're sticking to a massive weight in growth, but also remember, we don't trade growth as a growth factor from a French. We trade it a lot more narrowly, like cybersecurity, lithium or whatever. So that's our point of view on growth for the time being. We mentioned that the market is fully priced on the Fed, and we think it is. I think it's too fully priced on the Fed. This is the Fed long run forecast, long run, i.e. 5 years, versus the 5-year rate, and we can see that the market sort of closed the gap to the forecast to where we actually are in a almost perfect balance. For us, this means that we should be pretty much done in the fixed income market. We can even see, if I can find that graph, never mind, there might actually be a buying opportunity, the 10-year opening up. Now we're already in a bull curve steepener, so if we bought that 10-year from a bull point of view, we would actually end up with a very aggressive position of the 2-year. We're not really prepared to do that quite yet, but it will be certainly interesting to see. And the way for us to express this view is, again, keeping growth in our portfolios. Because again, we have survived the pricing that's already happened. Now we're in balance, according to this. This is not the time to start to take off positions. This is actually the time to stick to them, which is what we're going to do for the time being. And for the data, obviously the Fed's going to hike with 50 basis points. We think ISM will climb, which is quite interesting from a business point of view. The US business cycle is just accelerating all the time. It's massively strong. Yes, we do not buy into the last GDP number, because obviously the trade number and the inventory number were assumed. We don't have the actual data before the GDP data print. The day after, we actually got the inventory data print, sharply more than twice the consensus. And obviously, given the underlying demand in the first initial GDP number were twice as strong as it was in Q4, the underlying consumption, the underlying speed in the US economy is severely underestimated by that first GDP print, which we revised up, following the GDP numbers, and ISM is clearly telling sign that there's no weakness from that point of view. We think it will be a little bit interesting on non-farm payrolls. We have 50,000 in a forecast, which is quite low. We can see the job postings is rolling over, thanks to Macrobon with a great graph. We have our own indicators. And first and foremost, we believe the weather effect can actually start to play a little bit of a jeopardy here in terms of the forecast. Underlying this is also that we do actually see that the unemployment rate will start to tick up this or next month. Together with the peaking inflation sort of makes sense. But from the market's point of view, I think at one stage we need to scratch our head. Have we priced too many hikes? That's our bet. That's why we have a bull steepener on, and we're sticking to growth. But it'll be really interesting once we get into the Friday data number, which we forecast as a fairly low number, and also starting to turn in the unemployment rate. So in conclusion, we are pretty much where we were last week. We believe the US CPI peaked. We believe that wage and credit risk will limit Fed hikes. This is obviously not the consensus. We think we already got traction on this in Sweden. We're sticking to weight equities. Equities for us are better than bonds. But please keep in mind that we are fully almost out of Eurozone, and we prefer US, LATAM, and emerging markets. We are hugely positive on the reporting season where we are invested, obviously the US. We believe the global equity tidal wave has left us and probably won't come back for some time. We don't think we should sell in May and walk away. We think you should speak to an advisor before that, because that all depends on what kind of portfolio you actually are sitting on and what your beliefs are in terms of a new Euro crisis, to exaggerate a bit. And I'll leave you with this, which is our last position that we took last week, which is long US real estate, completely unhedged. We bought it in dollars. We could have bought it in various currencies, but we decided for dollars. We expect the blue to catch up to the underlying momentum in the US real estate. The contrast between US real estate and, for example, Sweden could not be bigger. We have one accelerating, one decelerating. So this again makes it, we can't even speak about equities anymore. We can't even speak about real estate because we have to define what real estate are we talking about, in which region, in what currency are we talking about it. So this is quite interesting for us. But this is our last position, or latest position we put on last week. It's slightly in the money so far, which is a good start. We'll see how much it carries through. But I will leave you there with some tip of an iceberg point of view. The entire presentation is on our webpage, it's on my social media pages as well, and you're happy to take part of the complete material there. Thank you so much for this week, and I'll see you next week.